Value stocks in action. All right, look at this chart. We're going to dive into it a little bit. I know it's a mess, but we're going to dive into it here in just a second. Remember, when you invest in a value stock, you're inherently taking more risk. A lot of people think value stocks are less risky. Nothing could be further from the truth. Nothing can be further from the truth. And the typical way you look at a value stock is low price to book relative to the S&P 500, high dividend yield relative to the S&P 500, and low PE ratio relative to the dividend of the S&P 500. So those three things: low PB, low PE, high dividend yield. That's how you look at a value stock. Now, inherently, it says, oh, wow, it has more upside. Yeah, it also has more downside potential, which is why it could be value stock. All right, so I'm going to show you value stocks in action looking at this, and we're going to show you in the context of an article I just read called Historical Perspective on Electrical Utility Regulation by R. Richard Geddes. And this is, I think, from the mid-'80s when he had written this for the Cato Review of Business and Government. This is fast. I've always been fascinated by energy generation, electricity generation, just energy in and of itself, but also economics with monopolies and whatnot. And so I want to read you a little bit about this, and I want to show you how it reflects this, and see if you, knowing what you know now, would have stayed, or not knowing what you know now, would have stayed on the course by value stocks from the 70s. So let's go into this. Now, I'm not going to read the whole article. I'll just read a couple tidbits. The traditional approach to regulating electric utilities involving exclusive geographic franchises and state commission. Now, what happened was before they had the state, so Wisconsin and New York, I think it was the 20s, I can't remember, but Wisconsin and New York passed laws, 1907, 1907, they passed laws where the state became the regulatory agency of electric utilities. Before that, it was all municipalities. So, I mean, literally, I live in Alpharetta, Georgia, for instance. They could have done whatever they want. And that led to graft. That led to inefficiencies, theoretically. So then the Wisconsin, New York passes state regulations, which everybody else has soon followed. And then the electricity regulation and the utility nature. You can think of utility, like monopoly. It's a utility. It means you're always going to have access to a good dividend, maybe not so much growth, but a safe stock. Then the state took over, and that's where we are today. The state commission approval of rate changes and capacity additions is increasingly coming under pressure brought about by several important economic forces. From the inception of regulation to the late 1960s, economic forces enhanced the workability of traditional regulation and created an age during which rate of return regulation works smoothly. As a result of demand-side technological and cost changes beginning in the late 1970s, however, the traditional framework was dealt a serious blow. That resulted in a re-examination of both the origins of that regulation and its underlying justification. In particular, the natural monopoly argument behind extensive price and entry regulation is undergoing reassessment. Come here, hold on, let me get my assistant. He wants some tummy time. No, he wants some TV time. All right, so let's keep reading because I find this to be incredibly interesting. And you will too. Look, you're like, why are you talking about this? So let me just, drop it on the ground. All right, so we got economic change and industry cost. The 1950s and 60s were relatively uneventful for the electric utility industry. The industry benefited from technological progress and economies of scales in generation, which led to falling nominal and real prices for electricity. According to the Edison Electrical Institute, nominal electricity prices declined and continuously from 1925, roughly the end of the wave of state regulation where the states took it over, until 1970. Demand for electricity grew rapidly throughout that period. Utilities performed well financially and rarely filed for rate increases, but instead often voluntarily decreased their rates. Therefore, the regulatory system of extensive price and entry control worked smoothly during that period. The regulatory system often worked in favor of the utilities since costs decreased before regulators decreased rates. The resulting regulatory lag allowed utilities to earn returns on investment greater than their cost of capital, while the customers were heartened by declining rates. Public involvement in the regulatory process was nominal. All right. Several factors work in concert during the early 1970s to change that placid situation, though. First, productivity gains slowed as a result of the exhaustion of scale economies in electricity generation and a slowdown in technological innovation. At the same time, coordination economies among different utility systems were fully exhausted. Love you, buddy. Second, the cost of inputs increased sharply owing to fossil fuel price shocks from 1974 and 1975 and again in 1979 and 80. Third, more extensive environmental regulation of electrical generating plants began in late 1960s, further intensified in the 70s, and markedly raised construction costs and increased construction times. At the same time, the rise of nominal interest rates increased the cost of capital and further raised construction costs. Both the real and nominal costs of supplying electricity increased dramatically in a relative short period of time. All right, so keep thinking about that because we're going to keep going, how this would affect you if you're thinking you're going to be a value investor. In response to those cost changes, utilities filed more frequently for larger rate increases. Initially, the regulatory systems accommodated those cost increases by allowing the request of rate hikes. Regulatory lag, however, began to work against utilities as costs increased faster than rates. Consumer groups, correctly viewing rate determination as a part of a political process, did not acquiesce to those hikes. Environmental groups provided additional opposition. Commissions began to resist rate increases, although the proposed rates accurately reflected cost conditions and thus would have given utilities a constant rate of return. Interesting. The old regulatory system was not able to deal with such dynamic and dramatic economic change, and as a result, utilities became increasingly under financial stress. Some new regulatory mechanisms were created to deal with the cost increase, such as a fuel adjustment mechanism, which automatically passed on higher fuel prices to consumers. By 1978, all but 5 states instituted some type of fuel adjustment mechanism. In general, however, rates were not keeping up with the cost during that period. All right, let's keep going because I'm telling you. The financial impact of price inflexibility and the cost increases and disallowed capital investment was profound. After 1975, electrical utility common stocks fell below their book values. Electric utility common stocks fell below their book values in 1975. Before 1968, earned rates of returns on equity were constantly higher than the average cost of new debt. After approximate equality between 1968 and 1973, earned rates of return fell far below interest costs, reaching negative 3.91% percentage points by 1981. Utilities generally failed to earn their allowed rates of return. The financial performance of utilities did not improve until 1985 when fuel prices and interest rates finally declined. The lesson of that experience was not lost on utility managers. The expected rate of return on investment in new capacity must compensate for this regulatory risk. And given the current low rate of investment in new capacity, that return is apparently perceived to be below cost of capital. All right, so an efficient reform of electrical utility regulation would allow less politicized, more market-oriented determination of prices and capacity that would diminish the opportunity to distort prices. All right, so what's happening here? Remember I said value stocks, low PB, low price to book. You could not get a more value stock than utilities in the 1970s because they were trading below the book value. So if you have a price to book of 1, that means it's trading right as book value. A price to book of less than 1 means trading below. So that would have been a good time to buy, right? Well, let's take a look, shall we? Because let's see what the political system looked like. And I'm just going to read you from newspapers.com. And here's from the Capital Times, and this is in Madison, Wisconsin. 1970, August 13th, 1970. Power shortages may bring nationalization of utilities, is the article. Senator Ed Muskie from Maine, who we had a bumper sticker on the crappy piano that my mom had in our house, and we lobbied for in the caucus in Maine in 1976. Yeah, I think it was 72. I can't remember. 76 for sure. Said Muskie warned delegates at the American Bar Association convention that lack of action on power shortages could lead to nationalization of the power industry. He said the nation governmentally is at a stage of the first incandescent electric bulb, and technologically is in the danger of massive electric power failures. Yet no planning is being done on the local, state, or national level. And he said with each power failure or slowdown will be a public outcry that could stampede Congress into passing legislation which might provide for federal preemption of state and local government authority for nationalization itself. All right, so that's in 1970. Now, you might not know, but if you look at the 1970s in the UK, nationalization was running rampant. Now, I mean, they just nationalized everything. They were nationalized everything after World War II, probably before that, frankly, but certainly after World War II, until Miss Thatcher, Margaret Thatcher, the Iron Lady, came and she said, enough of that! No more socialism! We're taking over and we're allowing the free markets to take off and lead us into a decade, a generation, I should say, of prosperity, which he did. But anyway, so we're looking at nationalization in the UK, all right? We're looking at nationalization potentially here in the US of A. And we got other things on nationalization. Actually, it's funny, when you go to newspapers.com and you type in nationalization of utilities, you'll see a bunch of things from 1959, which was Castro taking over. It's funny, actually, how that comes up. It's funny, history is how history kind of leads the way. It's interesting to go back into history. That's why I like looking at newspapers.com, because you're reading articles about Castro. Here's Allentown, Pennsylvania. Investor, nationalization of utilities is discounted. Some guy says, he writes into William Doyle, who's an author here in the Allentown Morning Call, it's probably AP. I would like to know what would happen if the federal government were to nationalize utility companies in this country. I know that people say this is unlikely, but I believe that we're moving in that direction. Anyway, so that was in 1965. They're talking about. That's just one paper. I get that, but let's keep going. I'm not going to read you what William Boyle, whatever his name, says, but let's see. That's in Brattleboro, Vermont. Let's see what this says. This is Canada nationalization, page 1 of Canada. King George. There you go. This is page 1 from not Canada, from Brattleboro, Vermont, and this is in Dateline 1946. King proposes nationalization of utilities and opening of a parliament. That's King George VI was saying that. This is the UK in 1946. I got to put you down, buddy. All right, so then we go to, we got the Anniston. This is Montgomery. In fact, it's funny. They have George Wallace was talking about if utilities don't lower prices, they're going to have to deal with nationalization. And he's talking about that in 1977. And here we got nationalization right here. So I'd rather see government not be involved in the regulation of utilities. On the other hand, there's a growing sentiment for nationalization of utilities, says Wallace. The arrival of such nationalization would be a sad day in the United States, but we brought on by the utilities unless they make greater efforts to increase efficiency and lower costs. And that's in 1977. So just tons of nationalization of utilities, i.e. political risk. I mean, you can read, there's so much. In fact, I don't know if I can show this to you or not. Let's see. If you go to right there. If you go to newspapers.com, you can see that right there. I'm looking at this right here. Basically, that's the amount of interest in nationalization of utilities from going back in time. It jumps up in the late 50s and jumps up in the 60s and 70s. In the late 50s, it jumped up simply because of Castro. But in the late 60s and 70s, it jumped up here as well, as people were discussing nationalization of utilities like crazy. And you can't. I hate it. The idea, though, can you blame them? All right. So here, all right. So in May 1965 to September 66. And I'm reading an article from the Capitalist Times, all the news that's fit to report. This is Dateline October 2016 from Roger Conrad. History's take on current valuation of utility stocks. Anyway, he goes over the previous 17 corrections in the utility sector's post-war swoons. And again, utilities are known as a safe, grandma thing where you can get good stock. Whoa, no, sir. A good stock for cheap, not cheap. You're not going to get much. No, Pablo, no, you can't have that. No. You're not going to get much growth, but it'll be safe, and you'll at least get a good dividend. No, Pablo. All right, so let's take a look. May of 65 to September 66. Utility index was down 18.6%. April 67 to March of 68. This is literally 6 months later. Utility index was down another 13%. November 68, 8 months later to June 70, utility index was down 30%. Then we go another 6 months for another year and a half, down 15%. We wait another 6 months for about almost 2 years, down 49.9%. We wait another, what's that, 3 years roughly, for another 3 years, down 20%. So would you have bought utilities during that time? Knowing the outcry for nationalization, knowing what was going on in the world in the UK, knowing that the energy shocks because of OPEC, of Iran, of the Mideast, of all that, would you have bought utility stocks? Remember, they're low price to book, right? Low price to book, knowing the regulatory nightmare that we had to contend with, environmental consumer advocates, Ralph Nader and all that. I mean, that's a value stock, man. Would you have bought it then? And so the issue that comes with value stocks outperforming growth stocks, it is something I actually subscribe to. There's some that say that's not true anymore. I don't believe that. I think value stocks actually will outperform. I think for the last 10 years, growth stocks have outperformed. And once we get back to a more of a revert to mean, value stocks will again look like better investments in the long run because they're riskier. Inherently, they're riskier. This is risky stuff. This is risky stuff. You're buying things with a low PB ratio, low PE ratio. The reason it's low PE ratio because if they get nationalized, there are no more earnings. The earnings are gone. And if the earnings are gone, you're not making any money. There's no dividends to pay. If the nationalization takes over, you're done. You're done. You lose your capital, that's for sure. So I'm telling you right now, when I hear people, I'm waiting for a dip. Okay, well, there's lots of dips. Would you have bought? Would you have bought when price to book was below current valuations? Price to book was below 1. All right, they were trading less than book. Would you have bought that? I don't think so. I think a lot of us, me too, would say, yeah. Would you have bought Apple in 1998 when it's trading at 7? It looked like it's going bankrupt, but it's a value stock. I don't think so. Anyway, this is why I spread your risk. You don't buy a couple of stocks and think, oh, they're going to be, you got to spread your risk, especially on the value side. Hope this helps. Would love to hear your comments. If you are still here for this long thing, I'd like to, do you remember back in the 70s, actually? It'd be interesting to hear your comments. I just remember, I just remember being cold. All right, I remember my mom not being able to heat the house. I had to open up the oven, and I can't remember how we electrically, I just don't remember. I just remember coming home to a freezing cold house, all right, and then sometimes having to live with neighbors because we didn't have heat coming on. And I lived in Maine, and sometimes having to open the oven to heat the house. I guess we couldn't afford the oil or something like that. I don't remember people saying turn the lights off, or I definitely don't remember saying, close the door with the air conditioning on. You don't want to, what are you trying to cool up the outside or something like that just because we didn't have air conditioning. But I don't recall saying, turn the lights off, you're wasting valuable electricity. I mean, now, we still kind of say it, but no one really, it's not that big of a deal anymore because electricity is pretty cheap. Do you remember that back then in the 70s? I'd love to hear your comments on that. Like, man, oh yeah, I remember getting whooped if I left the lights on in the bathroom when I got done brushing my teeth or something like that. I just don't recall. All right, we'll see you.